Well, hello everyone, and thanks for coming back today for part 2 of our webinar series, An Introduction to Crypto Investing for Professional Wealth Managers. I'm Daniel Tardent, Head of Marketing at Blockchange, and today's topic is cryptocurrency as a new asset class. Now, last week, if you joined us, we introduced the fundamentals of crypto assets. And today we focus on historical returns and volatility, correlations, and creating the portfolio. And in the remaining weeks, we'll be covering crypto investing fundamentals and creating a crypto portfolio. So by the end of the series, you'll have a good idea of how to get started engaging with digital assets for your clients. Now, we'll be starting in just a few moments, but before then, a few housekeeping items for you. So first of all, regarding questions, we will be answering questions. So if you have a question, please enter it into the Q&A tab and we'll answer as many as we can at the end of the webinar. Now, just to be clear, the Q&A tab is not the chat window. So use the Q&A tab for any questions, if you could, please. The second point is that we are recording today's webinar. So by participating, you're giving your consent to being recorded. Okay, so that's housekeeping out of the way. Now, for some of you, this may be your first exposure to Blockchange. So let me spend a moment on that so you understand why we're here today and where we fit in the digital asset ecosystem. So Blockchange is a digital asset management platform for professional wealth managers and advisors. It brings the modern portfolio theory-based tools of traditional finance to the world of digital assets. And the platform is tailored to small and medium-sized wealth advisory firms to enable financial advisors to quickly and easily manage investments across their client base. So in a nutshell, Blockchange allows you to manage digital assets for your client base in much the same way that you manage traditional assets today. If you'd like to learn more or see a demo of the product, you can do that on our website at blockchange.ai. Okay, so let's get started with the webinar. And just to reiterate, today's topic is cryptocurrency as a new asset class. Our presenters are Dan Eyre, who's the CEO of Blockchange, and Griffin Knight, who is our head of product. So without further ado, I'm going to hand over to Griffin to get you started. Griffin.
Hey everyone, my name is Griffin Knight and I'm the head of product at Blockchange. I have a background in finance and previously worked at a management consulting company that focused on firms in the alternative investment space. But perhaps most importantly, I've been a crypto enthusiast ever since I discovered it 4 years ago. So while none of this in this presentation is investment advice, I do hope that everyone is able to learn a little something about cryptocurrencies in this presentation. So as for the agenda, I will first take you through the historical returns and volatility of Bitcoin relative to a handful of other equities and asset classes. Then we're going to look at the correlations of Bitcoin compared to other traditional asset classes. And then lastly, Dan will walk you through some scenarios of different portfolios after adding small allocations of Bitcoin to them. So first, we're going to go into the returns and volatility and along with the Sharpe ratios. But I wanted to make a quick note on the data that we're going to be using for this analysis. So crypto data before 2014 is somewhat less useful due to the lack of size, liquidity, and transparency. So therefore, all of our timelines are going to be starting in 2014 or 2015. You also may notice that we are exclusively using Bitcoin when we're comparing to traditional asset classes. And this is primarily due for similar reasons, but in that Bitcoin has the best data for the longest period of time. But as you'll see, this BTC works as a pretty strong proxy for the crypto industry as a whole. So with that, let's get into the returns. So we decided to show Bitcoin's returns against a handful of other assets. So first, we chose Tesla to show an example of an equity that is pretty popular these days and has actually a pretty similar return and volatility profile as Bitcoin. Second, we chose Facebook as it is kind of like, I don't know, the quintessential FANG stock that have done so well in the last decade. Third, the S&P for obvious reasons. And then lastly, gold was chosen in that it has a very similar use case to that of Bitcoin. But as we can see in the charts, Bitcoin returned by far the most in our 5.5-year time frame out of the assets that were chosen, or 6.5, gaining over 1,000% in the total time. However, we also see that Bitcoin had more inter-year volatility than the other assets. So now let's see how this price action looks over time. So this graph is assuming that you invested $10,000 on January 1st, 2014 into each of these assets. We can see that Bitcoin performed poorly relative to our other assets for the first few years until it had a massive run up during the crypto bull run of 2017. And it brought our theoretical portfolio value all the way up to 180K. However, despite the subsequent crash, bringing the portfolio value down to 44K, we can see that it still ended up higher than where it started before the run up. And it actually has rebounded quite significantly in the last 2 years since it crashed. However, while it is clear that Bitcoin has had the best returns over our time horizon, it was also much more volatile. So let's take a look at the volatility of all these assets and see how they compare. So what we can see from this top chart is that our highest returning assets also had the most volatility. So what I mean by that is if you were to rank all 5 of our assets by the amount that they returned, it would actually be the exact same ranking if you did it by volatility. So that ranking being Bitcoin, Tesla, Facebook, followed by S&P, and then gold. So one interesting thing to see here is that while Bitcoin did have the most volatility, it didn't have that much more than Tesla, returning 3.99% versus 3.21%. And while volatility is not a perfect proxy for risk, it can still give us an insight into how risky the market sees something as. So it's important to understand that volatility is really just the market saying it isn't quite sure how to value something. But that's where the opportunity lies from an investment standpoint. So related to this point, volatility is also largely dependent on the size of an asset. So the second chart here shows the market caps of the assets that we analyzed, and in which we can definitely see a trend between the volatility of the asset and its market cap. So therefore, Bitcoin and Tesla having the smallest market caps, they're also having the most volatility. So now that we've looked at returns and volatility, I wanted to now look at Sharpe ratios. So quick recap on Sharpe ratios. Sharpe ratios measure an asset's return divided by the volatility or standard deviation of those returns. And the reason this is important is we want to make sure that we are being compensated for the amount of volatility that we are taking on in an asset or portfolio. So I guess as an example, we can imagine that an asset that has monthly swings of 20 to 30% up or down, all else equal, that will be less desirable than an asset that fluctuates 1 to 5% per month. But also it depends on which direction that volatility is going. And that is really what the Sharpe ratio is aiming to depict, is that if an asset fluctuates wildly, we want to ensure that its expected return is high enough to make up for this volatility. And this chart shows the general guidelines on how we frame Sharpe ratios. So with a 3.0 Sharpe ratio is excellent, 2 is very good, 1 is acceptable, and then anything below 1 would be considered poor. So this chart is showing Bitcoin's Sharpe ratio over the last 6 years as compared to some other big asset classes. So the x-axis is time, and the y-axis is the Sharpe ratio, with a 4 at the top going all the way down to -3 at the bottom. And as we can see, Bitcoin has and has maintained by far the strongest Sharpe ratio of the group. So really what this is telling us is that despite the volatility, Bitcoin's returns have been significant enough to make up for it. So next, we're going to look at correlations of Bitcoin to the S&P, gold, and then to other crypto assets. So, but first I want to do a quick recap on correlations to just remind everyone how they work and what their importance is in relation to finance. So 2 variables can have a correlation coefficient somewhere between -1 and 1. A coefficient of 1 means that the variables have a perfect positive correlation, and a coefficient of -1 means they have a perfect negative correlation. So an example of something that would have a strong positive correlation would be like say, height and shoe size. While it's not perfectly correlated, we can be fairly confident that in general, the taller someone is, the larger their shoe size will be, and vice versa. An example of something that would have a strong negative correlation would be temperature and articles of clothing. The hotter it is, the less clothing you need, and vice versa. Now, correlations are important for finance when we're building a portfolio, really for the purposes of diversification. So all else equal, it would be better to have two assets in a portfolio with negligible correlation than it would to be for two assets with high or perfect correlation. And this method is how one obtains the best expected return for a portfolio, particularly by lowering the volatility. So one property of Bitcoin that is commonly discussed is its lack of correlation towards traditional assets. So looking at its correlation with the S&P, which is what this chart is showing, we can see that historically Bitcoin has hovered between positive and negative 0.2 for the last 6 years, which brings us to an interesting point, which you should be able to see on the chart during the last month or so. Is Bitcoin now correlated to equities? It certainly looks like it, judging by this chart. So I do have a few points on this. And the first is that even a moving average of 0.5 correlation is really not that high. And consulting our chart from the previous slide is only a moderate correlation. And just to put it in reference, Twitter had a correlation of 0.75 with the S&P over a similar timeline. But second, we really need a longer timeline to truly determine whether this is a trend or not. We just don't really know right now if this is a general trend or just something that's been happening due to the craziness in the markets. And lastly, and perhaps the most important, is that Bitcoin is not a safe haven asset yet. It is trying to become one. And I think that's an important distinction to remember. And in that sense, it kind of acts like a call option on a safe haven store of value. But as it continues to grow and attain that goal, we can expect it to behave more and more similar to that of gold, which is truly uncorrelated. But until then, a massive rush for dollars like we saw in March will have the riskiest assets sold off first, Bitcoin being included. And I actually wrote a Medium post a couple of weeks ago that goes into some of the COVID-related Bitcoin movement, especially when we had those couple crazy weeks in March. But for reference, we also wanted to show the correlation of Bitcoin to the S&P with that of gold to the S&P, so we can see how gold actually looks correlated to the S&P 500. And gold is really the marquee safe haven uncorrelated asset, which, as I said before, is what Bitcoin is aiming to be. But what we're able to see here is that Bitcoin's correlation to the S&P is very similar to gold's over its history outside of what we've seen in the last month. Now that we have seen how Bitcoin stacks up to the S&P, let's look at how it compares to the yellow metal. In this chart, we're looking at Bitcoin's correlation to gold. And as we can see, there's really not any meaningful correlation between the two, maintaining a coefficient somewhere between 0.2 and negative 0.15. And this is actually really important because it means that Bitcoin does not need to act as a replacement to gold in a portfolio, but can actually act as a complement. So I'm going to kind of pivot a little bit in that throughout this analysis, we've been using Bitcoin as a proxy for the crypto market as a whole, primarily due to its age, liquidity, and relatively high quality of data. But as most people know, there's a large number of cryptocurrencies, and that's what this chart is showing. It's showing other large cryptocurrencies' correlation to Bitcoin over time. And if you attended the first webinar last week, you may be wondering why assets which have such different use cases would be so highly correlated. And really the answer is that the market still looks at crypto as a single entity, despite the sometimes significant differences between asset classes. Your first observation from this chart may be that it looks like crypto assets are getting more correlated over time, but there are really a few things I'd like you to consider. So one is that crypto assets have very, very low liquidity early in their lives, which leads to pretty extreme price swings that could be triggered by only one large trade. That's really why I believe this explains some of the moderate correlation that we're seeing in the earlier parts of the chart. And really, the other thing would be I would expect that as the crypto market gets larger and people begin to understand better and are able to separate different cryptocurrencies by use case, that we'll see a long-term trend as far as a reduction of correlation to Bitcoin. So in summary, while we're closely watching the correlations of Bitcoin to the S&P, gold, and that of other cryptocurrencies, what we've seen historically is an asset class that does not correlate with many of the traditional ones. So with that, I will pass it off to Dan to go into some of the portfolio creation scenarios.
Thanks, Griffin. Hi, folks. My name is Dan Ayer. I'm the CEO of BlockChange. And prior to BlockChange, I spent my time in enterprise financial planning, modeling, and forecasting. And today I'll be covering portfolio creation. So for the portfolio creation section here, we're going to analyze a few different types of portfolios to get a sense for what a practical example of allocating to crypto assets looks like. We're going to start off with a familiar 60-40 stocks to bond portfolio, followed by tech stocks, and ending with significantly more diversified portfolio. And for the purposes of all of these analyses, we're assuming a rebalance on an annual basis, and included a benchmark for the US market throughout using the Vanguard 500, which is essentially, it's a diverse index of equities that make up about 75% of the US stock market's value. So let's get started by taking a look at the first portfolio with the standard 60-40. So in this analysis, we're looking at 60% stock, 40% bonds. And the chosen assets represent a fairly generalized investment approach focused on mid-cap growth and broad market index for stocks, while on the bond side, we're split 50-50 between corporate and municipal bonds. So for the purposes of a meaningful comparison here, we've introduced a 2 and 5% allocation for scenarios 2 and 3 respectively to Bitcoin. So if you look on the left-hand side, you see 1, 2, 3. And the second and third scenario there are the 2 and 5% Bitcoin allocations for the same portfolio. So let's take a look at how these different scenarios performed. So a few things to notice here. While the Sharpe ratio looks fairly high for the 5% Bitcoin allocation, the Sortino ratio shows the volatility is actually primarily upside. So we can also see that most of that upside is also non-correlated to the US market. For a stock and bond portfolio, allocating a small percentage like this to Bitcoin appears to be a meaningful decision, as the worst year for versions of the portfolio containing Bitcoin were actually slightly less painful. Even looking at the maximum drawdown, the trough for the portfolio containing 5% Bitcoin represented an incremental correction of less than 1% from the previous peak. These results would indicate that Bitcoin is conclusively value add to a portfolio like this over the relevant time period that we're looking at here. So next, let's take a look at tech stocks. And in this analysis, we're using FANG stocks. Griffin mentioned those earlier. We're really using, for those of you unfamiliar, Facebook, Apple, Amazon, Netflix, and Google, but we also added in Tesla because it's become such a popular mainstay. And these stocks have really been the bedrock of technology investments for more than a decade. And they've consistently seen excellent returns with marginal volatility compared to the broader market. And in this case, we've introduced the same 2 and 5% allocations as in the standard 60-40 analysis. And let's take a look at how they stack up. So the tech portfolio's compound annual growth rate is already staggering relative to the broader market. And we can see the approximation of that disparity between the blue and green lines on the chart. Just a reminder that the green line is that Vanguard 500. And we're seeing a slightly different situation here, though, as the base tech portfolio is actually significantly less correlated to the US market than in our previous scenario, the standard 60-40. We're not seeing the same level of exaggeration and performance delta between scenarios with Bitcoin versus scenarios without Bitcoin when it comes to FANG stocks, because the performance of FANG stocks has outpaced the broader market in a significant way. There's undoubtedly more volatility once Bitcoin has been introduced, but it's not as pronounced. And again, it's pretty much all upside. So third analysis here, we're looking at a more diversified portfolio. This is a little bit more, it's non-traditional, I'd say. And in this portfolio, we're really trying to cover broader ground. So we're investing in science and technology, biotech, private equity, real estate, bonds, and commodities, which in this case is gold. And we're adding Bitcoin to the portfolio, which is, it's not really a massive leap because it's already quite diversified. But it's worth taking a look at the performance in our same three scenarios of no Bitcoin, 2%, 5% for scenarios 1, 2, and 3. So let's look at how this diversified portfolio performed. So the first thing that stands out here is that over this time period, a diverse portfolio has actually significantly outperformed our standard 60-40 that we looked at in first analysis, which was actually below the Vanguard 500. And from a performance perspective, the diversified portfolio sticks pretty close to the Vanguard 500. Even though it deviates significantly from equities and other asset classes, we're seeing similar performance, which is kind of interesting here. The correlation is pretty much right in between the standard 60-40 and FANG in terms of this diversified portfolio. And the upside is more apparent here versus the 60-40 as well when you add Bitcoin in. And overall, with Bitcoin added, we're looking at non-negligible risk, but as usual, outsized returns here as well. So let's talk about the key takeaways from all of this. Kind of everything Griffin covered and everything that I've covered. Outside of black swan events, Bitcoin has low correlation with U.S. markets. So we did see an uptick in the last 30 to 45 days in correlation, but that's not typical. The rest of the 10-year history of Bitcoin actually shows very low correlation. Second, Bitcoin is also not correlated with gold. So it's, diversification is the only free lunch in investing, and being able to complement something like gold that's not correlated to U.S. markets with, another asset that potentially is going to behave in a similar yet different way to gold, potentially holds a lot of value. And third, while Bitcoin is relatively volatile, that volatility is primarily upside. So when you look at things like the Sharpe ratio and Sortino ratio, that's what that's indicating. And fourth, objectively speaking, Bitcoin was the best investment opportunity of the last decade. There was nothing else that you could have invested in that would have provided the same level of returns. And there is potential for the same to be true in the future as the crypto asset ecosystem continues to evolve. I mean, no one has a crystal ball, but if the past is any indication of the future, and if you're kind of joining these different webinars that we're doing, you'll get a taste of what the industry is doing today and how it's going to evolve. It's certainly possible, and I think that it's worth kind of paying attention to here. And so that is why we're doing this series is to educate. So that kind of ties a bow on the content here. And now we'd like to turn it over to some Q&A.
Okay, great, Dan. Thanks to you and Griffin. So we have a few questions from the audience. So let's go through those now. Also, I wanted to mention that we did have one report that someone was not seeing their screen syncing. So hopefully that was just an isolated case, but in any case, after the webinar today, within the next 24 hours, we'll be sending out a link to everyone who attended for the recording of this, and that will definitely have the correct screens for you to see. Okay, so let's look at the questions that we have here, guys. So the first question is, you said that you're only focusing on Bitcoin in this analysis, but how have other cryptocurrencies performed in this analysis? Is Bitcoin the outlier, or is it representative of other mainstream digital assets?
Yeah, so as I mentioned in the presentation, it's hard to model most cryptocurrencies beyond 2 or 3 years ago, primarily because so many of them either came into being 2 or 3 years ago or got enough liquidity that for all intents and purposes they might as well have. So that's when their market caps got reliable enough to start performing analysis on. And we're getting to that point where we can start start using them for our analysis. But perhaps the most useful, or the biggest reason why we used Bitcoin instead of a crypto index as a whole is that, as you saw from that slide, the crypto assets have such a high degree of correlation with Bitcoin that until that breaks, it works for the analysis to just use Bitcoin. But as those use cases get further defined, I believe we're going to start to see more of a bifurcation.
Okay, thanks, Griffin. So second question, Dan, maybe you could take this. Why would financial advisors treat cryptocurrencies as an alternative investment? It's hard to treat it like stocks or alternatives when it requires a combination of client and advisor education.
Yeah, so I mean, I think the full potential of cryptocurrencies and other digital assets are still being realized. The behaviors of the asset class are less predictable than mainstream investments like equities and other types of securities. So because the asset is less predictable than most common investments, it does introduce levels of risk that you wouldn't assume with your broader portfolio. But you would take a small to medium allocation that you would typically see with something like gold or private equity, real estate, or other alternatives. So I think taking that same approach really makes a lot of sense as kind of a proving ground where you can participate in the upside, but you're not risking it all. And that's how you would normally approach like alternative investments in general.
Thanks, Dan. I also wanted to mention that, as blockchain, we recognize the issue of educating clients to make them understand the opportunity with digital assets. And that's actually a big part of our focus here. It's one of the reasons that we're doing things like the webinars that we're doing today. And we'll be doing a lot more of this type of thing as we move forward. Okay, next question. Can you explain to me the different categories digital assets are splitting into? And Dan, this is probably one for you too.
Sure. So far what we've seen is that digital assets can act essentially as a currency, one, two, a transferable measure of utility. These are often called utility tokens. And third, a financial instrument such as like tokenized stocks, bonds, notes, and other common assets that you would see today. And even though this is the case now, this is by no means a comprehensive list because just like the internet, the full extent and impact of blockchain and digital assets won't be fully understood for years. So we're really seeing it kind of play out in real time here, but there are already those like few different major categories.
Okay, Griffin, next question for you. Is this investing or gambling clients' money?
Yeah, so actually, that's a great question. And it really gets to the core of the difference between investing and gambling. And there is a difference. Now I'm going to sound like a Nassim Taleb book here, but it primarily comes down to the difference between risk and uncertainty. So gambling is making a bet with risk. Risk can be thought of as having, you're unsure on the outcome, but you know what the stakes are. So think about playing blackjack or playing roulette. You know what the odds are. Whereas when it comes to investing, you're dealing with uncertainty, which means you have no idea what the odds are. And as far as an investment decision, when you're dealing with that level of uncertainty, the payoffs can be extremely, extremely rewarding if you guess correctly. And so that's how, similar with a lot of speculative investments, that's why I think there is definitely a difference between gambling and speculative investing, even though definitely the line is somewhat gray.
Okay, thanks, Griffin. So here's an interesting question. You guys can decide who wants to take it. Is there a legal risk to advisors who don't allocate to this asset class? Is the financial advisor abandoning their fiduciary duty by not allocating to the best performing asset class available to their clients?
Yeah.
Okay.
Yeah. You want to take that one?
Yeah, sure. I'll take that one. So no, there isn't any legal risk. At least that's not the way that it's seen today. Who knows what the future holds? But in terms of fiduciary duty, I think the most important thing to highlight here is that before an advisor with that fiduciary duty invests in any asset, they should understand how it works. And until they understand how it works, they shouldn't take any risks that they don't have any context for. And that's really why, the education piece of all this is so important because, really objectively speaking, it is the fiduciary duty of an advisor to invest in the way that's going to be most rewarding for their clients with an acceptable level of risk, which, especially Bitcoin these days is appearing to be that asset that you really want to take a serious look at. But I would say, until an advisor really understands and takes the time to kind of research and, get the full context of what's going on here, they probably shouldn't be participating in the market. But more and more these days, to that end, we're seeing a lot of organizations that are starting to look at this for the first time, or conversations are really evolving to the point where they're beginning to make moves into the market. So I think that, right now there's no legal repercussions, but I think this is rapidly evolving, and this market it's not going anywhere. So it's definitely something to watch. Griffin, I don't know if you had anything you wanted to add.
Yeah, I mean, I'd add that, I think that as a fiduciary, you should be providing your clients with all possible opportunities. You shouldn't let too much of your personal biases get in the way. And so I think, especially for the younger clients who aren't nearing retirement, in my opinion, at least being open to offering them an asset class with a risk reward profile that crypto offers is going to be increasingly a very smart move.
Okay, thanks, guys. So Griffin, I think you can take this one. So the highs are very high and the lows aren't as low. Couldn't I find another asset that performs similarly over this time period? Why is Bitcoin different?
Yeah, so as far as the lows or the run-ups falling down higher than where they started, this is a kind of a classic Gartner hype cycle, which happens a lot with new technologies, where it starts low, there's a huge spike, there's a crash, but that crash is higher than where it started, and that has happened many times throughout Bitcoin's history. It's happened about 3 or 4 times, and it's the exact same pattern every time. But I mean, as far as other assets performing similarly, I mean, definitely there are equities that performed very, very well over a similar time period. And one example would be like AMD. AMD had like 1,000% return over the last couple of years as well. But how Bitcoin is different is, to me, it's you have to look at what is the total possible size that this thing can get to, right? I mean, like with an equity like AMD, I mean, the largest company in the world, whatever it is now, one of the FANG stocks is like $1 trillion. Whereas the market cap of gold or the M2 money supply, which is comparables to what at least Bitcoin is trying to do, are orders of magnitude larger than $1 trillion. Well, maybe not orders of magnitude, maybe one order of magnitude if you include M2. But yeah, so that's really why, to me, is you have to look at what is the potential value that it could reach relative to the multiplied by the probability that it will reach that.
Okay, great, Griffin, thanks. And Dan, this one's for you. Would you say valuing cryptocurrencies is difficult because it's not tied to any other asset?
I would say that arguably the interesting thing here is that cryptocurrencies have a very well-established value, kind of because you look at the market for them, it's decentralized and distributed globally. So price equilibrium is actually formed from a very broad consensus of diverse demographics. The challenge isn't really determining the value today, it's actually determining the future value of the assets based on their potential underlying utility. And I think that that's really where a lot of the discourse is, with people trying to understand, what really is that underlying utility. And in some cases it is pretty broad and diverse. So Bitcoin is just one example of the utility of the underlying technology. And we talk a little bit more about that, or actually a lot more about that in the first part of this webinar series, and there will be more about that to come. But I think it really is important to understand from kind of look into the future how big this can get. To Griffin's point that he just made, is to understand how it works and what the impact is going to be on various industries. Yeah.
Okay, thanks, Dan. So Griffin, I'll point this one to you because you talked a little bit about this earlier. It looks like Bitcoin was affected by COVID-19 as much as everything else.
Yeah.
Question.
Yeah. So, I touched on this a little bit. I wrote a Medium post on this a few weeks ago called "Bitcoin Drops and COVID Badness: What Gives." So I definitely recommend people check that out. But just to kind of summarize what I go into in that article, the first thing is, I touched on this a little bit in the presentation, but Bitcoin is not a store of value asset yet. It's more like a call option on a future store of value, and that's a very important distinction. It's similar to the asteroid mining analogy I made in last week's presentation. But another thing I go into is that in a risky time such as we had last month and we're still having, during a time when everyone needs cash, they're going to sell their riskier assets first, and Bitcoin and other cryptocurrencies fit that profile. But as far as even just like a store of value asset, even let's just say it was that at its current state, that's a hedge against inflationary environments, not deflationary shocks. And a pandemic is textbook deflationary shock, assuming, well, at least in the short term, right? In the near term, the Federal Reserve and the government are going to work to ensure that that's not the case, which is where things get interesting when you have high deflationary pressures faced against high inflationary pressures. You can start to see some pretty interesting things develop.
Thanks, Griffin. So just a couple of questions left here. Looks like, so let's see. How worried should I be on the highly volatile asset since I serve as a layer of defense for my client?
Yeah, so I mean, volatility and overall risk, for that matter, are critical elements of analysis for wealth managers when constructing portfolios for clients. And in that sense, advisors should definitely always be concerned with risk. Although the key here is to understanding the full picture of risk reward for any given asset. And this relates back to the Sharpe ratio and Sortino ratio. And depending on which cryptocurrency, that risk reward relationship can be highly enticing and represent really excellent opportunity for advisors looking for diversification without diluting upside. It's a good way to sum it up.
Okay, and then here's another, just had this other question. And what is your viewpoint about the acceleration of crypto adoption being affected / driven by the US dollar devaluation risk via federal debt and seemingly unlimited printing of money?
Yeah, I can take that one. So, yeah, I mean that's the $1 billion question. In that, Bitcoin seems to be fairly well placed at this current point in time. I mean, I think it's telling that. So in the first Bitcoin block, a message was encoded by Satoshi that says, "Chancellor on brink of second bailout for banks." Now, obviously, it was created in 2008, but that kind of shows you what at least the initial creators' thoughts were as one of the intentions of creating it as a currency. And so we're at a point where I think we're going to start to see some pretty interesting ways that Bitcoin could be affected by what's going on in the global economy, because that kind of goes to my deflation inflation point, which is, I mean, we're in completely unprecedented monetary times as far as what governments are doing in response to a once in a lifetime black swan event. So I can't give you an answer, but I'm really excited to see.
Okay, and Griffin, maybe you want to take this as well. Since Bitcoin is priced against US dollars, can it be a hedge against the dollar dropping in value?
Yeah, absolutely. I mean, to me, that all comes down to scarcity. So when something acts as a store of value asset, you would prefer that you don't get diluted through the issuance of additional currency or whatever that unit is. And that's why traditionally precious metals have been better than government currency to do this, because you can't print more, you need to mine more. And that's why, especially now with the money printing and whether or not the dollar increases in value or decreases in value, in the end, it's going to be more extreme than what happens with Bitcoin, because Bitcoin has, and a lot of other cryptocurrencies have, a fixed supply schedule, in that we know exactly how much is going to be made over what given period of time. So, if you can stomach the volatility from an inflation perspective, you're definitely hedged. But there's other risks associated outside of just that.
Thanks, Griffin. So Dan, this is our last question, and I'll point this one to you. Would you say digital assets are shaking up the industry in a fundamental way and how money is transacted? Would you call it revolutionary?
So yeah, and I actually wouldn't stop there. Digital assets are really looking like they're going to impact nearly every industry that has a digital presence. And it's probably going to revolutionize how money is transacted, but also how information is shared and how systems run. So we spoke a lot about this in the first part of the series, and the recording is available by request. But yeah, I mean, I think it's beyond just money, right? It's about how the general protocol, the underlying protocol, like the internet itself, incited fundamental change, and that's, I think, what we're looking at, kind of the next generation of that.
Okay, that was a great question to finish up on, but we do have one more. So let's look at this one. Can cryptocurrencies be a low risk for older people to get into?
Yeah, I mean, to me, it's all about portfolio allocation, right? So where, and it's the same sliders that you would play with on bonds and equities, right? So depending on how close you are to retirement or whether you're already in it, allocating less than 1%, 0.5%, 1%, that's going to have not as much downside, but still maintain the upside that you could get. So that, I'd say that's how you minimize the risk, right? Is just by reducing the allocation. But there's no one who should be completely shut off from investing in it, right? I mean, especially since you can buy the smallest denomination of cryptocurrencies. You can start with $20. So it's really finding that sweet spot of where it makes the most sense for your personal situation. But somewhere around 1%, maybe less, might be a good place to start.
Okay, thanks, Griffin. So that's the end of the questions that we've got. So before we talk about next week's webinar, Dan and Griffin, any closing comments or on the questions or the topics before we move on?
Sorry, go ahead.
So I mean, from my perspective, it's great to have sessions like this. It's also good to check out. We do a lot of analysis, and there is a 4-part series that you can check out on Medium. A lot of the articles, a lot of the pieces there, Griffin has created and done a lot of pretty rich analysis. So I said, I'm thinking they're definitely worth checking out if this resonates with you, what you heard here today. But other than that, I mean, there's a lot of content moving forward that I think will also be quite interesting in parts 3 and 4.
Okay, thanks, Dan. Okay, so that's the end of today's webinar, everyone. I'd like to thank everyone for joining, and also thanks to Dan and Griffin for their presentation and insights. So before we wrap up today, just a reminder to join us again next week for part 3 of the webinar series. And next week, we're going into crypto investing fundamentals. So that's on Friday at 11 a.m. Pacific,
Yeah,
2
and
p.m. Eastern.
let me just jump in real quick to kind of give a preface on what that's going to be about. So when you're evaluating equities, you know, you look at things like price to earnings, you know, book value. We've had hundreds of years to come up with ways to value equities. We've had about 8 years to come up with them for cryptocurrencies. So the intention of this next webinar, webinar 3, will be to say, okay, great, we understand the use case of crypto, but how do we take a quantitative approach to determining, you can almost say, the health of a blockchain? How is the adoption happening from a variety of different KPIs and metrics? So that's what we're going to be covering next week.
Okay, that's great. Thanks, Griffin. Yeah, so please join us next week because it's going to be going in much deeper, and it's going to be more and more relevant for wealth managers and advisors as we go along. Okay, so if you have any questions that come up between now and next week, please email us at support@blockchange.ai, and we'll be very happy to answer those for you. And we also invite you to visit our website at blockchange.ai to learn more about the Blockchange platform. Okay, so thanks everyone for joining today. Enjoy the rest of your day, and we look forward to seeing you here next week.
Thanks all.
Thanks, everyone.